Module 4, The Accounting Process, Part 3. Intangible Assets. Intangible assets includes patents, copyrights, trademarks, service marks, trade names, franchising rights, and trade secrets. Some intangible assets are recorded as deferred charges, such as costs of incorporation or software development. Acquisition of intangible assets can, as with other assets, be recorded as expenses as they are accrued, or alternatively, included as part of the cost of development or acquisition and spread out over the life of the asset. Recall that an expense is deducted from revenue on the income statement, while acquisition and capitalization of an asset affects the assets and liabilities on the balance sheet. The practice of spreading an intangible asset's cost over the lifetime of the asset is called amortization. If it is not possible to discern the value of the asset or its ultimate value when developed, such as with intellectual property, it's impossible to amortize its costs, and its costs must be periodically expensed. For example, Acme Corporation spends $100,000 on advertising and promotion for a wearable technology product. Acme cannot immediately determine whether this innovative product will succeed, so it records the $100,000 expenditure as an immediate expense, not as an amortized cost. Acme also acquires a patent for $300,000 from LadTech Corporation with a life of 15 years. Here, Acme amortizes the assets at a cost of $20,000 per year for the 15 years. Research and development and computer software development costs are specifically cited by the rules of accounting as expenses, rather than asset acquisitions that can be amortized. Following the acquisition of an intangible asset, a firm can amortize its cost only if its useful life can be determined. Otherwise, it can only be treated as an expense. However, businesses must periodically determine if any intangible asset has acquired a useful life due to changes in circumstances, in which case the asset must be amortized over its remaining life. Goodwill, a business's reputation, is an intangible asset that's typically relevant when another business is acquired. Goodwill is part of the acquired company's value, not a separately identifiable asset. Goodwill is typically computed as the market value of the business, as evidenced by the acquisition value, over its intrinsic value. If, after a periodic assessment, a company appears to have lost value, its goodwill amount is similarly reduced. Rather than performing periodic assessments, private companies may simply amortize goodwill over a period to not exceed 10 years when purchasing a company. For example, Acme Corporation is valued at $10 million, and its non-goodwill assets are valued at $9 million. The difference of $1 million is Acme's intangible goodwill. If Beta Company purchases Acme for $10 million, it can amortize $1 million it paid for Acme's goodwill over 10 years. Securities and debt instruments. A business might purchase corporate or government bonds to earn interest payments. A bond is simply a loan. The issuer is the borrower, and it repays the bond's principal amount at its maturity date. Interest may be periodically recorded as income, or if a payment is pending, interest may be recorded as accrued. Historically, investors clipped physical coupons from a bond and then mailed them in to get their periodic payments. Thus, bonds that gave out periodic payments acquired the name coupon bonds, though today they're normally handled electronically. The rate of interest is called the coupon rate. Dividing the annual amount of the coupon payments by the bond's face value gives the coupon rate. For example, Acme Corporation buys a 10-year bond for $1 million and a periodic semi-annual interest payments at 7%, which pays $35,000 twice per year. Acme records the payments as increase to its interest revenue and increase to its cash account. The amount that a bond pays is called its yield. The yield can simply be the coupon rate. However, when interest rates change, the value of the bond can increase or decrease. When rates rise, the value of current bonds locked at the previous interest rates fall, and vice versa. For example, Acme Corporation buys a $1 million bond at a 10% annual rate of interest. Assume interest rates rise to 12.5%, and consequently the bond's price falls to $927,900 to simulate a competitive overall 12.5% rate of return, commensurate with other investments in the market. If prevailing rates fall to 7.5%, the bond's price would rise to $1,100,150. Bonds that sell at a price under their face value are called discount bonds, and bonds that sell over their face value are called premium bonds. Dividing the annual coupon payments by the bond price determines the bond's yield. If the bond is selling at face value, then its yield is the same as its coupon rate. Otherwise, the difference between its face value and price must also be considered. A company can also acquire stock in another company. There are 3 ways to record acquisitions of another company's stock. If a company owes less than 20% of another company's stock, then it simply records the stock acquisition at cost, and this is called, appropriately enough, the cost method. The investing company records any dividends it receives as income. The investing company may adjust the value of the stock account to reflect the market value of the shares. For example, Acme buys 150,000 shares of Labco at $10 per share. Acme records a reduction of $1.5 million in its cash account and an increase by the same amount in its investments account. Labco issues a quarterly dividend payment of 10 cents, which entitles Acme to a $15,000 dividend payment for its 150,000 shares. Acme increases its cash and dividend income accounts accordingly. If a company acquires 20% or more of the voting stock of another company, but less than a majority, the acquiring company records the acquisition under the equity method. The investing company is presumed to have some significant influence over the second company, but not full control. It records its share of the second company's income or loss on its financial records in proportion to its ownership. For example, Acme Corporation purchases 25% of Labco. Labco reports $100,000 in income in its financial statements for a given year. Acme would consequently record a $25,000 gain in its investment and income accounts, because that gain reflects its proportional ownership of Labco's stock. If a company forms a new company or acquires a majority of another company's voting stock, that is a takeover. That results in the first company, called the parent company, controlling the second company, called the subsidiary company. The financial statement column of the acquiring parent company and the acquired subsidiary company are combined, and the amounts are netted together. While this process is straightforward, a business will need to eliminate duplicate recording. For example, Acme Corporation acquires 70% of Labco's stock. Acme is called the parent, and Labco is called the subsidiary. Acme's financial statements show $120,000 in revenue, and Labco's financial statements show $90,000 in revenue for a given year. Acme would then combine its financial statements with Labco's financial statements into one statement that shows a total of $210,000 in revenue. A business might also issue its own debt instruments to raise capital. These are usually long-term obligations, meaning that their term for repayment extends more than a year. Bonds are types of debt instruments. Bonds may be unsecured, which means the bondholder has no recourse to make claims against the assets of the company if the company becomes insolvent. An unsecured bond is called a debenture bond. Bonds may alternatively be secured by assets that the company owns, such as property, plant, or equipment. Accounting for bond issues involves a bond payable account for the amount that the company must repay at maturity, and an interest expense account for the company's periodic interest payments. A business may issue debt that an investor may, at the investor's option, convert into another form of ownership. This is known as convertible debt. The investor could, for example, purchase a bond convertible at the investor's option to common stock. If the stock price is increasing, it might be a profitable transaction for the investor, a perk that can entice investors. Capital accounts. Capital accounts indicate the values in the company held by owners of a business. As we've observed, the owners of a corporation are called shareholders, and they have fractional ownership of a business denominated in units of ownership called shares. Share ownership entitles a person to participate in the management of a business by voting on important matters, such as major financial changes and for the board of directors. Share ownership additionally entitles shareholders a percentage of the company's profits, typically in proportion to the shareholders' interests, and payable in periodic installments called dividends. Stock may come in different forms. Common stock is ordinarily voting stock, which gives the owners of the shares the power to vote for directors, who in turn appoint the officers who run the company. Preferred stock shareholders ordinarily do not have voting rights, but they receive dividends ahead of common stock shareholders. In accounting, the value of stock is bifurcated into par value and additional paid-in capital. Stock is typically issued at a nominal value called par value, which often bears little relation to the actual value of the stock. Any excess value is recorded in a separate account called contributed capital in excess of par value, or more simply, additional paid-in capital. For example, Acme Corporation issues 1,000 shares of common stock, par value of $1, and selling for $40 per share. It records common stock at $1,000 and additional paid-in capital of $39,000. Aside from receiving cash from the sale of stock, businesses may also receive non-cash property in exchange for company stock, in which case the transaction is recorded at the fair market value of the property received. For example, Acme Corporation buys a manufacturing plant worth $1 million by transferring to the seller 10,000 shares of its common stock at $10 per share, for a total of $100,000 in common stock, and excess paid-in capital of $900,000. In addition, businesses must record net income, after deducting distributions and dividends to shareholders, in an account called retained earnings. Negative retained earnings are recorded as accumulated deficit. A business declares dividends by having the board of directors announce the dividends as of a declaration date. Particulars of the payment are made on the date of record. The ex-dividend date occurs just before the date of record, and only those who have stock as of that date are entitled to dividends. Historically, dividend payments were mailed, but many firms pay dividends electronically today. A business may also distribute property or stock as a dividend payment instead of cash. It may also distribute the right to purchase additional shares at a price less than the current market value of the stock. A business may split its stock by doubling the number of outstanding shares, which will accordingly reduce its par value. Or it may enact a reverse stock split, which will reduce its outstanding shares and consequently increase its par value. For example, Acme Corporation has 10,000 shares of authorized outstanding common stock valued at $30 per share. It splits its stock by giving its shareholders numbers of shares equivalent to double the amounts they currently possess, and halving its stock value to $15 per share. Allen holds 500 shares worth $1,500 and valued at $30 per share. After the stock split, Allen owns 1,000 shares, still worth $1,500, but now valued at $15 per share. Twice the shares, but half the price, and the same value. A business can also repurchase its outstanding shares, which reduces the number of shares available on the market. The repurchased stock is called treasury stock. Employees may share in the stock ownership of the company by exercising stock options, which can be classified as equity or liabilities depending on how they are structured. Similar to a corporation, partners in a partnership each have capital accounts in the partnership. The partnership agreement provides for the profit and loss allocations of the partners. Some partners may contribute more than others in terms of work or capital, and share differently in the profits and losses. Capital accounts may also be used to indicate that a partner is owed money for a capital contribution that she has made to the partnership. Some other types of assets. A business's treatment of leases is another accounting consideration. A lease may be classified as an operating lease or a capital lease. An operating lease is recorded as an expense, which reflects periodic rental payments. A capital lease is recorded as a cost that is amortized for the term of the lease. In a capital lease, the business acquires title and ownership of the asset at the conclusion of the lease term, or has the option to purchase the asset for a reduced price, as a bargain purchase option. How rental payments are structured, or how the term of the lease is set up, can also enable a business to classify a lease as a capital lease under the rules of accounting. The difference between the two is in the balance statement and calculations of a business's financial health. An operating lease is merely the periodic payment of rental expenses, but it does not reflect the underlying assets of the business. A capital lease changes the assets and liabilities of a business because it involves the acquisition of an asset financed by a creditor. For example, Acme Corporation considers acquiring a machine under a lease agreement for $1,000 per month on a 3-year lease. The lease payments do not affect Acme's balance sheet and are expenses reported only on income statements. But say Acme's management decides it will acquire the machine under a capital lease that will enable to own the machine after 5 years. This acquisition now increases Acme's assets because it's acquiring the machine. It also increases its liabilities because it's financing the machine with lease payments. Tax accounting is very complex, as tax accountants' key job typically is to minimize taxes. There's tension between maximizing the value of the shareholder's investments and minimizing revenue and its associated tax liability. The tax code allows businesses to deduct losses. The code even allows businesses to project losses against past year's financial statements to produce a refund. This aspect of the tax code is called carryback, and a company may reach back up to 2 years to project its current losses to past years to reduce its tax liability, and up to 3 years in some cases. A company may also use present losses as carry forward to reduce tax liability in future years. This option is available for up to 20 years. Businesses may elect to combine carrybacks and carry forwards, as would work best in the circumstances. Assets held by the company in employees' retirement or pension accounts must also be considered in a company's accounting. There are 2 essential types of retirement plans. In a defined benefit plan, the beneficiary receives a fixed amount upon retirement according to the employee's salary, years of service, and age. An employer must set aside this amount that its retirees will expect to collect, and depending on the retirement and fund performance, the company may need to make periodic adjustments, which may involve contributions to shore up the funds or address excess contributions. In a defined contribution plan, the employer makes contributions to the employee's retirement funds. The employees can typically choose the composition of their investment portfolios. The employer guarantees no particular level of income upon retirement. The assets of the retirement plan are held in trust and are not reflected on the balance sheet of the employer. In our next module, we'll turn to the preparation of financial statements and documents.